Hi there, this is Doug Fletcher for FutureTradingConcepts.com. This week we have a special high profit trade report for those of you who are trading or for those of you who are thinking about trading in the commodities market. Who is Future Trading Concepts? We are future trading educators. We primarily teach short-term traders. We believe in keeping trading simple. We have an exclusive nuts and bolts of futures trading, commodity futures trading course, and mentoring program. For details on this, please go to futurestradingconcepts.com. Okay, we're going to talk about a recent big channel breakout of the May 2013 wheat. Low risk, high reward trade we made back in December of 2012 through recently March of 2013. As you can see, there was a big move from December to recently in March of 2013, and we're going to show you how we traded this and profited. Okay, we're looking at the same chart as the previous chart. The only difference is we put what we call an overlay on top of it. This overlay is called a Keltner channel, and the reason I put this on top of the chart is so you could get a visual look of how the market back in July was very bullish, and it broke out of this channel until it reached approximately the 920 range and found resistance. Now, what do we mean when we say resistance? We mean price resistance. The price couldn't seem to go any higher than this 920 range. Then the market found itself in a sideways range between roughly 940 and 840. So the market was bouncing sideways for a considerable amount of time, and then at some point it decided to break down, and it became very bearish, and the market went down, and as you can see, it broke out of the Keltner channel. The Keltner channel helps us show where the support and the resistance of the market is. So we use this tool just to help us know the direction of the market. Okay, we're going to talk about this March trade. Starting back in June, the market reached a low, as you can see, in approximately the $7 area for this May contract. And we had a huge rally over the summer, mostly driven from the dry weather in the Midwest. Then in late July, the market started to slow down and found resistance in the $9 area. So the market started to look like it was a top was being formed right here, just above 920 area. So we continued to watch the market to see whether it was going to go higher or possibly go lower. So we watched it for a considerable amount of time, as you can see. We watched it through the middle of July, August, September, and we still didn't really have an indication of which way the market would go. But we did have a possible idea that maybe this market is bearish, but still not 100% sure. And how do we do that? Well, we went and we flew out to what I call a 5,000-foot view. This is our monthly wheat. This is going back 10 years. And as you can see, the wheat from 2009 to present was struggling to get past the $9 range. So that's the resistance area. Now, if you look here, we'll get into this little breakdown in a bit, but if you look here in this what we call a bear flag, you'll see these large ticks here are the run-up in the summer, and then this is the resistance in the September, October, November, December range before the market broke down, and you can see it was struggling to go any higher, but it still could have gone higher. At this point, we did not know what the direction of the market was going to be. So we went a little bit longer, and in November, we had a sharp spike against our resistance area in the 940, and we had a sharp spike against our support area in the 840 range. So we said at that point, we better start planning our trade. Buy if we get a sharp breakout above 940, sell if we get a sharp breakout below the 840. So we put an open order in with our broker, and the market finally showed a breakout to the downside on December 11th. Now, we were filled, that's what this F stands for, filled on 12/11/12 at 845 and a quarter. So we're now in the market with 5 contracts bearish. The S up here is our stop. We put our stop just above the $9 range in the 910 area, above near-term resistance. And our goal is $7. Now, again, how did we know $7? We go back to our 5,000 foot view and we look at our monthly chart again. And we said, okay, wow, back in 2009, the price struggled at $7 to get through. In 2010, it did get to $7. And between the years 2010 to 2012, $7 became support. Price did break down a little bit below support, and that $7 again became resistance. And last summer, during the drought period, the market broke through that resistance area and found resistance at the $9 area. Now, the market started to break down, and we said, okay, what is our goal going to be? That's when we determined our goal was going to be the $7 range. Now, the goal is a mental goal. There's a lot of ways you could go about achieving your goal. You could put a market order in, and if that price is hit, you could get out of the market. But in this case, we didn't know how the market was going to move past here, and we have a mental goal in of $7. At this point, we planned our trade. Our trade is filled, and the market continues. The market continued down after our first fill on 12/11. Now, we normally, when we get into a fast market, we look for an area of accumulation. The market was accumulating here in the 820 area and made a quick fall again into this 770 area. So we wanted to get a couple more contracts here. And we also noticed our stochastics was flat, meaning that the market was very oversold. So we were going to expect a bounce at some point in the market. But we decided to put an open order in to sell 5 more on a break below 770. The market did break below 770. We got filled on 114 at 762. We continued to watch the market, and we saw another accumulation up here in resistance in the $8 area, and again, support in that 770 area. Now, we could have considered to go to the market and just sell another 5 contracts here, but we decided to wait a little bit and see how the market went. So the market broke down again. And in the process of breaking down, we went to the market and we bought 5 more. On 2/22 of 13, we got 5 contracts at $7.38 flat. Okay, and the market was continuing at a rapid pace down. Now, we did reach our goal. Now, when you're trading this type of market, there's a lot of things you could do here. You could just go to the market and maybe buy back, have 5-year contracts bought back, and still hold on to 10, or mix and match any way you want. You could take your stop here and bring it down and tighten it up. And if the market bounces up, you could just get stopped out of all your contracts. Or you could do what we did and just take a back seat and give it a few more days and see how the market goes. And that's what we did. The market broke down further. Our goal was $7, and the market broke down to $6.80. We decided at this point, not only did we reach our goal, we also hit a low from last July. So we went almost full cycle around. So we went to the market and we bought back all our contracts at the same time, 15. So we bought 15 back on 3/7 of 2013. Now, before we talk about our profit and look at the monetary part of the contract, let's just go to the 500-foot view or the 1-year view of the wheat, the contract that we were looking at. This kind of takes you out so you can see it a little bit better. And again, you can see our run up last summer, our large channel we had all last fall into early winter, and then you could see how the market broke down. And you can see that our $7 was right in this area, and full retracement would be around the $6 range, which is quite possible that we could reach that as the market has already broken down clearly below the $7 mark. But we are out of the market now with a nice profit with 15 contracts. And now let me review the events that took place. Okay, we had a large channel. The channel was hitting against resistance and support. It finally broke down and was bearish. And we sold 5 contracts on 12/11 of 2012 at 8.45 and a quarter. We bought them back on 3/7 of 2013 at 6.91 and 3/4. Our gain was 7.5375 points for a profit of $37,687.50. Okay, we sold 5 more in an accumulation on 1/14/2013 at 77.62 even. And again, we bought those 5 back on 3/7/2013 at 6.91 and 3/4 for a gain of 3.5125 points for $17,562.50. Now we bought an addition or sold an additional 5 contracts on 2/22 at the market, 2/22/13 at 7.38 even. And we bought those back on 3/7/2013 at 6.91 and 3/4 for a gain of 2.3125 points or a profit of $11,562.50. So we had a total net gain of $66,812.50 on this trade before commissions. And this all took place in a period of 3 months. So it was an awesome trade, and we've had a lot of these in the past year. And we'll continue sharing these opportunities with you. So I hope you enjoyed my overview of our big wheat trade. Thank you for joining me at FutureTradingConcepts.com. Always remember to trade responsibly. Take a minute to review this disclosure. Remember, always plan your work and work your plan. Hey, thanks for stopping by. Don't forget to subscribe to our YouTube channel. There's many more videos to come here on our YouTube channel. I've seen today is a companion to the Commodity Futures Weekly trading videos found at our website at FutureTradingConcepts.com. If you're looking to start trading the commodity markets, start with our Nuts and Bolts of Futures Trading course and mentoring program. We truly do walk you through the steps to be a successful trader. This is not just a guide, but it's a guide to financial freedom. What's the next big market move? Join us at futuretradingconcepts.com and track our upcoming trades with us. Are you already a trader? Follow our markets using our exclusive trade tracker. Thank you again for joining us. Bye.